Welcome back to the show. Joining us here now, we've got Tom Becket, CIO of Psigma Investment Management. Now, he's put together something about why he's worried about cautious investors, something he calls the cautious conundrum. Tom, you're here to tell us about that. What is a cautious investor? What do they want?
Yeah, before I go into the details, Simon, you said something characteristically astute earlier when you said that investors need to look through the short term and focus on the longer term. And I think and feel strongly that most investors are becoming very complacent about the outlook for financial markets generally. And I think the last 6 years of excellent returns from all asset classes have lulled people into a full sense of security about the future. And in particular, one major thing has happened, and the actions of the central banks to lower interest rates to record low levels and then pump the financial system full of cheap yen, dollars, euros and pounds has created in some markets what I believe to be unsustainably high valuations, which at some point I think could create a big issue. Now, the biggest issues are in the safest asset classes, namely government bonds in particular, and anything linked to government bonds, so things like investment grade credit, some of those corporate bond funds that your watchers and followers and readers of your newspaper will certainly have in their portfolios. And some of these assets have really gone to unsustainably high valuations, which at some point I think will reverse. Now, the important thing for cautious investors to recognise is that the lesson I learned very on in my career was that most asset prices are driven by the government bond yield. And we're currently in a situation whereby, because of the expensive nature of government bond yields, many other assets throughout the spectrum of asset classes around the world have also become quite expensive. And most of the most dangerously positioned ones, I'm afraid, are in cautious portfolios, namely government bonds we've mentioned already, investment grade credit. In fact, all corporate bonds and all fixed interest investments I'd incorporate within the same conundrum. And likewise, as we move into the equity space, many equities or companies that are considered to be safe, dull, defensive businesses have also been caught up in the expensive trap, which makes the cautious conundrum particularly key at this point in time. So the conundrum for me is that investors don't realise quite how risky their cautious portfolios are, and they could be subject to quite significant losses or indeed just disappointing performance in the next few years.
So the risk that you've highlighted is basically that interest rates go up a bit faster than people think.
Yeah.
And it doesn't have to be, I think you've said it doesn't have to be particularly dramatic.
No, indeed not.
In order to cause that. But there's this old model of asset allocation where you've got some bonds, you've got some government bonds, you've got your blue chip dividend shares.
Yeah.
You described this, I think, quite well as it's all the same trade.
And I think that's absolutely correct. And it goes back to the point I made earlier about the first lesson is that the government bond yield drives asset class valuations throughout the world. So you really have to focus on that. And I'm not saying this is definitely going to happen, and for the next 6 months, next year, you could quite easily see something like the UK 10-year government bond yield tick down from 1.65% today down to 1%. I mean, we live in a world of, where valuations are almost irrelevant. You currently got the Bank of Japan and the European Central Bank printing so many of their currency every single day that it's just distorting values elsewhere. So don't make any short-term predictions. My central thesis is, in a 5-year view, you're likely to see inflation pick up, you're likely to see growth pick up. It doesn't need to pick up very fast to see interest rates also pick up. And, most of us are very old. Some of us are older than others. You still look very young, Simon. But, it's now 9 years since we last saw the last US interest rate hike. No one knows what impact that's going to have upon markets. I just think it's a time for people to say we've made a lot of money, reassess what they've got in their portfolios and make some changes.
So what do you think is the answer to this? I mean, presumably there's no absolutely right answer, but there's ways that you can position yourself to protect yourself against this risk.
Yeah, I mean, I think you need to think about correlations first and foremost. What are those assets that have performed best because of low government bond yields? And for me, again, that's obviously government bonds. That's also high quality corporate bonds. In fact, most fixed interest investments, as I said earlier, have been caught up in that. But things like infrastructure loans, infrastructure equities, commercial property, real estate investment trusts, to me, these are all part of the same trade. And, in particular, some of these defensive equity portfolios, which have done so well in the last 6 years, and fair play, and we've had them in our portfolios, some of ththese really are now linked really to the same one risk fundamental, which is rising or falling government bond yields. So if you think back to the early part of Q2 2013, when Ben Bernanke in his great misfortune talked about tapering quantitative easing, we saw an asset class sell-off that encompassed every single asset class around the world at the same time. Look at that experience, think about what performed worst, and think about what could happen when US bond yields finally start to go up.
And one of the things that was put forward, and I think you gents could probably comment on this as well, is this idea of basically don't buy expensive stuff. It's a good starting point to think from is what has not been pushed up to this very high valuation.
Yeah, I mean, and that usually comes, lock and stock with the risk profile, doesn't it? I mean, I totally agree about the dislocation. Having said that, of course, if you're taking a longer term view, you might look towards the emerging markets, which have had something of a difficult time recently, particularly the likes of China and India, of course, which without question has got the new emerging middle classes, which is good term for a number of sectors in the longer term, such as pharmaceuticals, for example. But then I guess one of the ways to look at it at the moment is throughout that particular rise that we've seen, which have been the unloved sectors. Is there a reason for that, or could they actually benefit? The mining sector is quite an obvious one, because despite everything else that's going on, the strength that you mentioned, particularly in the bond markets, the FTSE 100 was down about 6% in 2014. It's reversed that so far in 2015, but it was nonetheless a laggard due to the way that it's made up.
And I was just going to say, in terms of the interest rates, isn't there a chance that the Fed will not hike up rates this year?
Yeah, I think that's certainly the case, and I think the weak first quarter GDP data from the US and actually every data point we've seen so far this year have been under expectations, which has meant that the FTSE was a laggard last year. This year it's American equities which have been very much the laggard. So there is a case. My personal belief is that Yellen and her cohorts at the Federal Reserve would like to get some gun back in the ammo. So if we did see an end to this business cycle, they could cut rates again, admittedly from low levels. So that is a risk. And Richard, you talked about some of the best ideas I've had. So either you're a very intelligent man or you've stolen my ideas. But I totally agree with a lot of those things. The best way, as Simon put earlier, for investors to protect against the cautious shock that we see is to buy assets that are cheap. Fortunately, there are some solutions to that. And I think what is a cautious investor's risk? It's losing a lot of money in the short term, it's not achieving growth ambitions over the medium term, and really over the long term not keeping pace with inflation. The best way to do that, as you said, look towards the pharmaceutical sector, which we like a great deal, some of the emerging markets which ultimately will drive the inflationary pressures in the world. For everyone to say the emerging market dream is over is somewhat missing the point, I think, to a certain extent. So that is the best way for cautious investors to prepare themselves. But in the short term, absolutely anything could happen. I think certainly you could see bond yields fall further from here. I mean, it might sound ridiculous, but with the US 10-year Treasury yield nearly 2%, it's a high-yielding bond in the context of a German Bund yielding 9 basis points for a 10-year bond. I mean, that's just utterly ludicrous. If your inflation belief for the next 10 years is 2.5%, which mine is, you're subjecting yourself to a near 2.5% real negative return every year by owning German Bunds. That's creating distortions. The best way to protect against it is to look towards some of the ideas that Richard mentioned.
And where do you see, you talked about some of the opportunities there. If you're not the cautious investor, if you're a bit more adventurous, for example, where do you see the opportunities for those kind of investors? Yeah,
I mean, what I've said about cautious portfolios really has ramifications across the risk spectrum, but clearly, people who are growth investors probably have a longer term time horizon and also are willing to subject themselves to more volatility, although volatility is not a very efficient form of risk, but it's worth pursuing. So, the best long-term opportunities, we've mentioned emerging markets, we've mentioned pharmaceuticals. I'm very much a believer in places like China and indeed also in India. I mean, I think those are long-term investment opportunities which have been shunned by the market in the last few years. Developed world equities to me generally, and I know that you look at individual equities, but generally look quite expensive. Emerging market equities to me look quite cheap. And, really, if you want to think about inflation as being our biggest risk, like we do at Psigma, then I'd look towards some of the commodities. I mean, they've been really beaten down the last few years. Every asset class around the world, from government bonds through to emerging market equities, actually have gone up in the last 5 years. The one that hasn't actually are commodities. If you want to protect against inflation, that's probably your best bet. Maybe some agriculture might be a great opportunity, particularly as the demographics of the world should be conducive to rising agriculture prices.
Smaller companies, any thoughts on that?
I like smaller companies, and if you believe you're going to get a good end to the election, and I hope it ends sometime soon, and you believe that the Conservatives or a status quo anti-coalition could get in on May the 8th, I'm sure it's not going to be as clean as that. Actually, I think small companies could be a pretty efficient way of playing that. 2 years ago, much loved, now much distrusted by UK investors. I think the small cap equity sector could be the most efficient way of playing a decent end to the election, and by decent end, I mean a continuation of the sensible policies of the last few years. So small cap equities to me look quite attractive.
Okay, interesting stuff. Tom,
thank you.
Thanks very much. Richard, thanks very much.
Pleasure.
Moose, thanks for watching the Investing Show. Join us again next time.